So, Kathy, what I like about you is your consistency, and we have been talking about these themes, right, for a long time. Having said that, your performance has been really consistent. It's been a tougher year this year, and you've had flows out of your funds. I was tracking just, I think, over the last week, it's almost $1 billion. So, how do you keep your investors kind of energized in your philosophy and your thinking and your outlook, and confident in your strategy, in a moment where there's a lot of doubt out there?
Yes. Well, a couple of things just in terms of flows. In our biggest outflows were in March. There were a lot of commentators out there, shall I say, screaming about how ETFs would have to, or our ETFs would have to shut down, which is impossible. And they just don't understand the ETF infrastructure surrounding us. It's a beautiful thing. Let me tell you, the flows are no problem. Our spreads have not moved. But anyway, beyond that, um, what has happened is our price targets for the next 5 years, that's our investment time horizon, have not changed, right? Uh,
At all.
but at
Not at all. Yeah.
not, in fact, some of them have gone up as quarterly results have come out. Now, they're not going to change that much because that one quarter's result is not going to change a 5 year price target by that much. But the forces that the coronavirus put in motion, supporting all of the innovation that in which we invest, they are not looking back. And so what we are seeing is a 30 to 40% discount to peak prices in February for the same price targets. So we're looking at this saying, all right, on sale. Innovation is on sale. And oh, by the way, the bull market has broadened out. It is now embracing value and more cyclical stocks. So what has happened is the bull market has broadened, has strengthened, and that is usually a launching pad for our next move up. This happened,
Well,
if I can just say,
yeah.
2016, same thing. Fourth quarter of 16, after Trump, against all expectations, was elected, value stocks took off because we are going to have a big cycle of tax cuts, right? And our strategy went down. We were negative. But what happened was 2017 was one of our best years ever, save last year. And that's because the bull market had broadened out, included value, cyclicals were taking off, and the economy was on the mend. Our economy is very strong right now, and cyclical earnings growth and revenue growth is a competition to innovation. But if we're right on what's happening with commodity prices right now, and that's going to be extended, that is the ticket to the next move in our kinds of stocks.
Well, it's interesting too. What about though the tech underperformance, Kathy, that we've seen? How much longer do you think, we see that?
Well, you can never say when we've hit bottom. I mean, I can tell you that the valuations in our portfolios would suggest that over the next 5 years, again, if our research is correct, no promises. We believe that our portfolios will more than triple over the next 5 years. So that's more than a 25% compound annual rate of return over the next 5 years. Actually, it's approaching 30 after today. So, I'm looking at that with great confidence because these innovation platforms have hit escape velocity, and there is no turning back. There is no turning back. We're not going back to the old world. We're not going back
Well,
to the old world. So, my confidence has only increased in our strategies.
can I ask you, why did you guys get out of Apple? Your position in
So,
Apple?
So Apple was one of our cash-like instruments. It's an innovative company. It's in the innovation zone, but its characteristics are very defensive. So we will add names like Apple, the FANGs, Apple, Google, Facebook. We will add to those positions, or even reintroduce those stocks as a bull market. Our portfolios were up 150%. We knew there was going to be a correction. direction. And we just wanted to have very liquid stocks. Apple is a great company. It's going to do fine. It's a FANG. It's in a lot of portfolios. We are all about the next FANGs, but we will use the existing FANGs. If you see, they are acting very defensively. Become a defensive group. So we will fold them in, increase them when we see a move like we saw last year. When we see a decline, like the one we're seeing now, we're seeing much higher returns from the other stocks in our portfolio.
You know, you were talking about kind of value and cyclical, and I'm curious, are there any value and cyclical strategies right now that you guys have identified as ones you want to pursue?
Well, in our space strategy, ARKX, you'll find a lot of value-oriented stocks. Many people are surprised to see Deere, for example, in there. And what they don't understand is thanks to satellite technology and the increase in the number of satellites out there and the precision that we're getting from them, we are now enabling precision agriculture with autonomous tractors and drones. So without that constellation out there, that would not be happening. We think the two biggest applications or beneficiaries of the space race are satellites, going to enable mobile connectivity or connectivity around the world, broadband connectivity. It is really hard for us to imagine that 3 billion people in the world have no access to the internet or broadband. This is going to enable that, satellites, and also farming. And the other thing we think is going to happen much sooner than space tourism, or it'll be a much bigger deal in terms of revenue generation, is hypersonic flight. So any aerospace company focused on hypersonic flight, we're interested in. And they tend to be value stocks.
You mentioned earlier, there have been people who have been very vocal and public fans of you, and then some now have become your critics, or they criticize, you know, having a younger investment and, you know, group of analysts, your analyst team. What do you say to them?
I would say that's our secret weapon. Those analysts have their education and their feet in the new world. The most seasoned analysts, healthcare analysts on Wall Street, and God bless them, they've been great at what they do. Anything, they know all the code words and how to decipher them from the FDA, but they probably haven't experimented with CRISPR gene editing like our genomic analysts have. And they don't have advanced degrees in cognitive computing, including bringing behavioral science into it. So many of our analysts are coming to us directly from college, and they are fully equipped with domain expertise in a way that most analysts out there, again, very seasoned, are not, just because they didn't go to school and haven't been exposed to these new technologies. Now, I know there are a lot of PhDs out there, and they, of course, know a lot. But I would put any of our analysts up against the most seasoned analysts on the street when it comes to the topic of innovation and new technologies, right? That's our focus. And so why wouldn't we? I think we have a competitive advantage for a few reasons. Number one, our analysts, their domain expertise. Number two, their willingness to engage with the communities out there through social media and give our research away, not when it's finished, but as it's evolving, so that they can communicate and engage with the innovators themselves. So I think we have a competitive dynamic unmatched out there in the industry.